I think tech has the headlines. I mean, there's clearly weakness in other sectors out there. I mean, housing, interest rate sensitive industries are being hurt at this point. We'd probably expect to see the energy markets beginning to pull back. 4 or 5 years ago when oil prices dropped. I mean, that had a big hit to technology because the oil revolution is very different than it was 15, 20 years ago. There's a lot of technology out there for analysis and big data, and also how they're processing a lot of the seismic reports. So it's all very interconnected. But tech is leading the way. Tech has been leading us up. It's leading us down right now.
Well, that makes me, it's not confined to tech, because it can't be confined to tech. And you've just mentioned, we've mentioned in the last 24 hours, clouds, chips, software.
I mean, crypto's
obviously,
definitely.
Apple and social media, and then Bitcoin. I mean, it's just, speculation's just oozing out, not oozing, it's almost like tumbling out of the market.
We saw weakness in server chips, which was somewhat pointed towards the cryptocurrency space, where there's less dollars. I mean, just think about the customers at the end. I mean, are they financially healthy? Can they continue to invest money? What we'll also be looking for in some of these FANG names that you're mentioning that are weakening, what are their budgets going to be going forward? I don't think long term they're pulling back forever. I mean, there may be a temporal dip in their spending. It may be a quarter or two. But that is certainly something to keep an eye on for the whole supply chain.
Don't you look, though, at all of these stocks, and there's an idiosyncratic, there seems to be some kind of idiosyncratic reason for every one of them in some ways. But then the question is really, what do you think the overlay is?
Well, I mean, as a stock picker, that's what I'm supposed to figure out on a stock-by-stock basis. But we also think that where money's been going over the last bunch of years has been passive investments. So as they all went up together, they're all coming down together. And that's the opportunity for longer-term investors, is find that value where they may be overly punished just because of their association in these passive ETFs. So that's the work we're doing. We've certainly been more defensive with our cash position. That's something that we view strategically here going into the year end.
Meaning what, you bought at the lows in October, or you're buying now?
Well, we've had a cash position that's kind of oversized for a couple months for a variety of reasons.
You don't anymore?
No, we still do.
You still do.
And we view that as strategic as we go through this volatility.
But that sounds like you don't think we've hit the lows then.
No, we have not been much of a buyer in the last few weeks.
All right, let's get to Michael Tyler here. Michael, where are you on? You're listening to all this. What do you think?
Yeah, I think that what we're actually shaping up is something more like what happened in 2015 with the energy markets, where one sector had led the market up, and then a couple of things happened then. Remember, in 2015, the oil market crashed, the dollar soared, and the entire stock market stalled as a result. But it didn't go down a lot. And here we are this year. Tech has gone way up, but it's also taken a beating. So while you've got the fangs in bear market territory, quote unquote, on the other hand, they're all up, except for Facebook. They're all up between 10 and 30% this year. So it's not been a bad year for tech. And the second thing is, as interest rates have drifted up, that's been acting as a bit of a damper. There's concern maybe growth is slowing down overall. So I can understand why tech has come down somewhat, and maybe there's a little more to go. But in the broader context of the overall market, yeah, maybe it stalls the market, but we're up single digits this year, probably about 5 or 6% total return. And I think the market can survive this and do just fine. So we're sanguine about the market overall. But I think that it's wise to say that maybe the tech stocks still have a little more, I don't want to say froth, but they certainly have a little bit more of a valuation issue to work out over a period of time. So call it consolidated, as you did earlier.
Well, what does that look like?
Call it whatever you want. There's a bit more downside in tech, and then I think it rights itself. But the overall market is still doing okay.
The gloom's getting pretty thick. You sound like you're like whistling past the graveyard a little bit. I heard your voice crack a little bit when you were saying that, they're still up about, some of these are still up a little bit over the year.
The tech stocks,
we're okay.
Year to date,
huh?
Year to date, Amazon's up 30%. Netflix is
what
up
was
40%.
it up at the highs?
I mean, these things have done very well.
The gains have been cut in half.
That's true. The gains have been cut in half in that area. The overall stock market has not. It's done fine. It's up 5 or 6% year to date. And as long as the earnings keep coming through, and I think that's a big question that we have to keep asking, the market will be okay, even though rotation is happening. And it's clear that the defensive names are where there's more action right now because they are coming through. Consumer spending is still strong. Business investment overall is still strong. If we have a big change in the tariff picture with respect to China, and remember we're looking at 25% tariffs on $200 billion starting in a couple months. If that happens, that means we've got some real issues, and we hope that the G20 meeting next month will alleviate
Michael,
that.
I was thinking about if we had some type of positive news on China, I could see that like being good for like one day, but it just seems like we're in a period where that might not be enough either. And the reason I'm trying to get you to not be as optimistic is I think all the points you're making are probably right. I mean, earnings are good. Nothing is really, that many things have changed about the backdrop to the economy and everything else. But I don't think we should pretend, I don't think we should utter any positive things anymore. I think we should just embrace the gloom, and maybe that'll help make a bottom. Because the longer that you have holdouts that still say everything's fine and this is just a garden variety correction, that the longer it goes on. Because there's still people clinging to, we have some people, Kramer and others, looking for more of a V bottom. And maybe we haven't seen that yet.
I think this will take some time to work out. I don't think we're getting a V bottom.
That's a U bottom.
I think well, something like that. I mean, there was some technical damage done. It'll take some time to recover. That's right.
Look, I think we're going to probably have an extended U bottom.
You do?
Yeah.
So
no, I don't think we rebound that quickly. I think there's a lot of.
If you've got money you're not putting to work, you don't think we've really hit the bottom of the U.
Correct.
Yeah.
That's exactly right. I mean, I think that there's still some pain to go. I think, the interest rate market continues to be going up. It's causing impacts with our dollar, which for exporters. But we're also seeing in the supply chain adjustments. So as the China tariffs are impacting companies are pulling out of their investments in China and resetting up in countries around there, which longer term should be very helpful, but it takes time to move those supply chains, those assembly lines to Thailand, Vietnam, and other places.
Mike.